The following podcast is sponsored by Financial Sense Wealth Management. To learn more about our investment services, go to financialsensewealth.com or give us a call at 888-486-3939.
Garrett just spoke with Trump over the phone. Let's start there. Garrett, what did President-elect Trump say?
The majority of our conversation was about the debt ceiling. Trump told me he's not just keen to see it lifted, as we've all seen and covered so many times in the past, but he'd like to see it got rid of entirely, something that's been discussed really by Democrats mostly in the past, but something that he said he would welcome and would actively campaign for. He argued that the debt ceiling doesn't work for its purpose. It doesn't actually control debt at all. He told me in no uncertain terms this morning he'd like to see it gotten rid of entirely. I can tell you just within the last few minutes, Elizabeth Warren, the Democratic senator from Massachusetts, got the opposite end of the political spectrum on so many issues, tweeted her agreement.
This is the Financial Sense News Hour. Now, here's the Financial Sense News team.
Well, the major indexes took a nosedive this week as a result of bearish Fed meeting. The Fed lowered the Fed funds rate 1/4 point as expected, yet at the same time, they reduced the number of projected rate cuts for next year to 2 from 4, indicating inflation isn't where they want it to be. In the meantime, in Washington, the budget kabuki theater continues with the strong possibility of a government shutdown by this evening. Bond rates are spiking again, having risen a full percentage point since September when the Fed began cutting interest rates. Hi, everyone. I'm Jim Puplava, and welcome to the Financial Sense News Hour. Coming up on today's program, an extended interview with Jim Bianco as we discuss the implications for the market with the Fed's latest move, the budget battle in Washington, and the one stock in particular that could determine the outcome for the stock market next year. Later on in the program, Chris Puplava and Chris Sheridan will be here with another edition of Smart Macro.
I was a little bit too timid on the market this year or a year ago or so. I didn't see a straight up market, but much more volatility that didn't materialize. I think the stock market, the US stock market is in a bubble. When you look at the valuation, it compares to previous bubbles that we have had, be it in 2000 or end of 21 or so. And out of the last 140 years, this is one of the three most overvalued markets that we see. And depending on what yardstick you use, we are in that range that is bubbly. So I expect a lot of volatility because I do believe the liquidity that has been driving this bull market is beginning to dry up.
To listen to this full interview and gain access to all of our premium content airing during the week, where we discuss markets and big investment trends, often well before they reach the mainstream news, go to financialsense.com and hit the subscribe button.
If you're seeking financial advice and how to invest in today's markets, Financial Sense Wealth Management can help. From setting up or providing advice on 401k plans, managing corporate cash balances, to helping individuals, foundations, and businesses achieve their financial goals. Give Financial Sense Wealth Management a call today at 888-486-3939. Let us work together to help you get on the path to success. Financial Sense Wealth Management has been named as one of the top investment advisory firms in the U.S. by the Financial Times. Let us put our financial expertise to work for you. Call now at 888-486-3939 or email grow@financialsense.com. Advisory services offered through Financial Sense Advisors, Inc., a registered investment advisor. Securities offered through Financial Sense Securities, Inc., member FINRA SIPC. Both companies doing business as Financial Sense Wealth Management.
Well, the Fed met this week and they cut interest rates as widely expected. But what was not expected is they lowered the number of rate cuts next year. What does this mean? Well, market didn't seem to like it very much. Joining us on the program is Jim Bianco from Bianco Research. Jim, let's begin with the Fed. This is the third time that they've cut rates since September. And it's interesting because in September, the 10-year Treasury is at 3.6. 3 rate cuts later, it's at 4.6. What's going on here?
Simply is that the market isn't liking the idea that the Fed is cutting rates. Now, why would that be? Well, I think really the idea here is that the economy at the top line is growing at its potential, the fastest it can grow without creating inflation. And I will emphasize at the top line, yeah, underneath there's some issues, but monetary policy lowering interest rates can't fix those. And we've got the Trump administration coming, and we're looking at potentially more inflation through tariffs, deregulation, and tax cuts, and that's all considered to be stimulative. So the bond market's saying that's more than enough. We don't need the Fed to be cutting interest rates. If they're going to try and stimulate by cutting interest rates on top of that, all they're doing is producing higher levels of expected inflation. And, if you own a fixed income investment and you think inflation is going to go up and your real purchasing power is going to be diminished by higher inflation, that's bad for bonds. So that's why we've seen something that hasn't happened in 40 years. The Fed has been cutting rates and long-term yields have risen by a full percentage point. The last time we've seen anything like this, where the Fed cuts rates and long-term rates go up, was in the 60s and 70s when we were worried about inflation. And every time the Fed cut rates, it was met by a large no by the market and, proceeded to see higher long-term yields.
The other thing that as I look at, the market got very excited when Trump got elected. What do we have? About a 1,500 point run in the Dow. We've given most of that back now. But Jim, the conditions that existed in 2016 are a lot different than 2024. The national debt was a little over or close to 20 trillion. Now it's over 36 trillion. Oil was around $40 a barrel. Today it's closer to 70. And the budget deficits are much, much larger, even in a growing economy. So what's the likelihood that anything that he's going to do is going to be inflationary? And because one of the issues in the campaign was inflation itself, but many of these policies could end up becoming inflationary.
Yeah, I think you're right. Going back, bigger picture, I think that the cycle turned in 2020, that prior to 2020, we were in a 40-year bull market in bonds. We were in a low and stable inflation world. And coming out of that, we're in a much higher inflation world. So I like to say we're in a 3 to 4% inflation world, not an 8-10 Zimbabwe inflation world, and higher interest rate world. So if we're already starting with that as our backdrop, then stimulating the economy could produce more inflation and it could produce higher interest rates. Now, let me say a quick word about that. There is a perception, and this goes back to the pre-2020 era, that the perfect interest rate is zero, and that any interest rate above zero, the higher you get above it, the worse it is. That's not necessarily the case. The perfect interest rate for an economy should approximate its growth rate. So if you add in inflation and real growth, and in the US, we're talking about 5.5% or 6%, then you're looking at interest rates that might be normal at a 5 handle, somewhere between 5 and 6%. That's not necessarily a bad thing. We saw that throughout, the second half of 23 and most of 24. The Fed left the funds rate at 5.25 to 5.5. And the stock market went up, the economy advanced, and so there was really no issue with interest rates being that high. Now, the problem is when you cut interest rates when below their natural rate or where they should be, you then introduce the idea that you could be overstimulating and having inflation, especially if we're in a new inflationary cycle in the post-2020 era. And so that has to be, concerning. Now, the biggest issue with Trump is being a real estate developer from New York. He's going to look at every uptick in interest rates as a disaster and say that we have to get interest rates down. But like I said, we might be in a world, and anybody who's old enough to remember what the world was like pre-2008, where 5, 6, 7% mortgages were kind of standard fare. That was the world we lived in. And we might be returning to that world. And yet all these people that are whining that they want back 2 and 3% mortgages, that was a different era. We're just in a different era now. And that era is because of the potential of higher inflation.
I want to talk about something else. We had a repo crisis in 2019, and Jim, reserves are about to drop below the level they were at when the Federal Reserve initiated its balance sheet reduction policy. Let's talk about QT and where the repo market is now and what that might mean for stocks.
So in 2014, the Fed started this reverse repo facility where it is basically used by money market funds, where you can basically hand the New York Fed your money and they will pay you an interest rate on it, known as the reverse repo rate. At its peak in 2022, it got to about $2.2 trillion in it. Roughly half of all the money in money market funds at the time was in this facility. Today, this facility is dwindled down to around $120 billion from 2.2 trillion. And a lot of people think, it might be on its way to zero, and that makes sense. Now, keep in mind what this means. When a money market fund gives its money to the New York Fed and gets an interest rate, it is one of the safest investments they can give, and it's a competitive investment. But from a liquidity standpoint, it means that it's removing money from the financial system. It's sitting at the Fed. It's not sitting in the financial system where it could be borrowed against, lent against, rehypothecated, all these fun words that we like to use about how the funding system works. As this system dwindles, it is adding money to the financial system. It's adding liquidity because it's no longer at the Fed. You're buying treasury bills, you're buying commercial paper, and it's going back into the financial system. So you're right, at 120 billion, there's not a lot of potential liquidity left to shove back into the financial system. Is this a concern? It is, but there is a new facility, new in the last couple of years, called the Standing Repo Facility. And about 30 odd banks have signed up for it, and a bunch of them have tested it. And what it is that if we were to get into a situation where there's not enough liquidity in the financial system, these banks can go to the Federal Reserve and do a repo. Remember that giving your money to the Fed was a reverse repo. This would be borrowing money from the Fed in a standing repo facility that would help to alleviate any liquidity concerns. Now, a quick word about liquidity concerns in about 2019. The plumbing of the financial system is so complicated that no one, including the Federal Reserve, including the FDIC, including Jamie Dimon, including me, everybody, it's hard to understand. And so these liquidity problems can pop up without a warning in the market. So that's why we have the standing repo facility. And that's why people are rightly concerned about it. What does it mean for you or me as an investor if there's going to be a liquidity problem? With the standing repo facility, I don't think initially much. I wouldn't lose sleep over it. I would lose sleep over it if I was a bank manager, the treasurer of JP Morgan, and that I have to meet my quarterly earnings and a liquidity squeeze could put a damper on it. I'd be worried about it if I was the treasurer of Goldman Sachs and we've got a bunch of securities that we're borrowing against. And if there's a liquidity problem there, that could impact our earnings. If I'm an investor in a fund, or if I'm an investor in an ETF, or I have my money with a wealth manager who has his money in investment grade securities, it might wobble the markets a little bit, but I wouldn't be worried that there would be a broader systemic problem at this point. Now, could it get worse? Sure, but there's always risks in the world, and I would put that risk at very, very low. But right now, the potential liquidity is about in the marketplace, and the concern is if we have to get more liquidity, where's it going to come from? Well, we're going to borrow it from the Fed. Well, the problem with borrowing it from the Fed, if you're JP Morgan or Goldman Sachs, is it will come at a price, but you can get it, but it will come at a price. So if I own an ETF in bonds or if I own an ETF in stocks, I wouldn't be that concerned about this right now.
Let's talk about the stock market itself. If you take a look at a chart of the Dow, it looked like it fell off a cliff. The S&P and the NASDAQ is holding up much better. But Jim, it seems like we're back to the Fab 4 and the Mag 7 again.
Yeah, we are. As a matter of fact, those stocks are now approaching 34% of the S&P 500, which would put them, the top 5 or top 7 at the highest concentration ever. I mean, ever is in the S&P. Technically, the S&P was created in 1957, and we've never seen such a handful of stocks be such a big weighting on it. And that divergence you're talking about, there's market breadth, the number of stocks that go up and down, and that fell 13 days in a row, the longest streak ever. All that means is that more stocks declined on the day than advanced on the day. but given the composition of the advancers, most of the time the S&P was either unchanged or up on the day, and the Dow fell 10 times, fell 10 days in a row for the first time in almost 50 years. So there is a lot of churning in the market going on right now. I think that it's one of two things. You're right. It is part of the Mag 7 stocks, and it is interest rates. Interest rates kind of really impact like regular companies. And then there is the Mag 7. And quick thought for you about the Mag 7. Goldman Sachs held an investment conference last week. Mark Rowan spoke at the investment conference. He of Apollo and was one of the people that Trump interviewed to be Treasury Secretary. And he said something that is, we've heard it before, but I've even heard it from somebody like Mark Rowan say it, is that if we are interested in the stock market, if we have investments in the stock market, the single most important person, and I'm paraphrasing what he said, the single most important person in 2025 for our returns is Jensen Huang, the CEO and founder of NVIDIA. Even if you don't own NVIDIA, it is such a dominant stock, and it is in the dominant industry. It's in the center of AI. It's a dominant stock. It's a $3 trillion stock. It's the driver of the Mag 7. So goes NVIDIA. So goes every investor. And like I said, you might not even know how to spell NVIDIA and don't own it, but it will impact all of us. If that stock soars like it did in 2024, everything was up, or if it corrects hard in 2025. But that's the nature of the markets that we're in now. Even if you're a global investor, I think that is probably the most important company. And Jensen is the guy that founded the company over 30 years ago and is still the chairman of the company. And therefore, he has this enormous influence on it.
What about some of these market caps? I mean, Apple's now approaching 4 trillion, almost the GDP of Germany. Microsoft is up in the threes. Amazon is approaching. You talked about NVIDIA is at 3 trillion. I've never seen valuations this high on a few companies.
Exactly. And really what it is this, I want to say this is a legacy of 20 years ago. AI is coming. AI is here in some degree, with large language models and ChatGPT and the like. And you can see the enormous potential of AI. And it could be bigger than the internet itself. But now that I've said that, the problem with these enormous market caps in the Apples, the Metas, the Alphabets, the NVIDIAs of the world, even Tesla as well, is the market has priced in this AI revolution now. So it's not good enough to say there will be an AI revolution. It's not good enough to say, if you look at ChatGPT or Gronk, or if you look at Microsoft Copilot, and you see the potential of these products, and you say, boy, these could be world beating. It has to happen in 25 or in the first half of 26. There has to be a time on it. Otherwise, the market will grow very impatient. I'll give you an example. In December of 99, so 25 years ago, Time Magazine's Person of the Year was Jeff Bezos. Why was it Jeff Bezos? And they had a picture of him in an Amazon box. Here comes the online retailing revolution. And that story 25 years ago was 100% correct. But what was not mentioned in the story was, but it's going to take 25 years. It's not going to take 3 years. That was implied with the story. Because right after that came out, Amazon stock fell 95% between December of 99 and November of 2001. It did not get back to that December 99 high until about 2011 or 2012, nearly 13 years later. So if you bought into the idea that, boy, this internet thing is going to change the world on online retailing, sitting in 2024, you'd say, see, I told you. See, I told you. And Amazon stock is up 200 times more than it was in December of 99. And not only is online retailing come, but online retailing has changed the very nature of the way we live our life because of things like Amazon. However, what I didn't say was, for the next 13 years, I will have made zero money, and you would have been questioning, where is this online retailing revolution coming from? It took longer to unfold, but when it did, it was every bit as big as we thought. If the AI revolution takes longer to unfold, it could be every big as big as we think it will be, But given the valuations in these stocks, there's going to be huge disappointment in that investors will grow very impatient waiting for it. And that's why you could risk some turbulence in them.
So, given where we are right now, we've talked about stretch valuations, money once again concentrating in the Mag 7. You've got a Fed that's basically saying, well, maybe we might change course a little bit. We're not going to be as aggressive on rate cuts as once planned. We've got the bond market backing up. What happens, Jim, if we start getting bond yields back up over 5%?
So let me start with that second part. If we get bond yields over 5%, that's, first of all, they're not that far away. We're at 4.75 in the 30-year and around 4.50 on the 10-year. So they're within sight of 5%. I think what happened with the Fed meeting, just to put a bow on that 5% number, is we use this term hawkish cut. It's a made-up term. I don't know what it means. I don't know if anybody knows what it means. I think what it means is the Fed made a mistake. But we're not allowed to say that the Fed made a mistake, so we have to use some euphemism for it. And what was the mistake the Fed made? If you read what the Fed said, if you looked at what the Fed's forecast was, they were pretty hawkish. Their forecast raised the inflation rate for the next 2 years. Their forecast for real growth was fairly decent. You would have concluded just from that, oh, so they raised rates on Wednesday. No, they cut rates. And they said they're going to cut rates more. And that's why I think that the marketplace, as I said earlier, is thinking, no, we don't need this. This is too much. And that's why I think you saw that bad reaction why interest rates went up. I would argue to you, why isn't the Fed talking about maybe we're done cutting rates? Maybe if inflation doesn't start to behave better, we might have to raise rates. Because Donald Trump's going to be the president in about 30 days, and they're afraid of his social media accounts, particularly Twitter. And if the Fed starts talking about we're done cutting, we might have to hike in 2025 because this inflation problem is sticky, Trump would be correct to point out, oh, so you were cutting rates when I was running for president to help my opponent. And then the minute I become president, you stop and you threaten to raise rates to punish me. Now, maybe there's completely justifiable reasons to do this, and I think there is, but that's not an inaccurate statement of the timeline that we would be looking at. We already know that Donald Trump hates Jay Powell anyway, and he's talking about firing him. And so I wonder if they're trapped by the politics of it, that they can't come out and say what they really think, that maybe we should be done cutting rates and maybe we should be looking to hike rates if inflation doesn't acquiesce, but they're not saying that. And I think the bond market's reacting with, if you're not going to be serious about this inflation, we're not going to be serious about owning bonds. Now that I've said that, the first half of your question, what does 5% yields mean? Well, this is not 2019 or 2018. This is not TINA. There is no alternative. When the bond market was yielding 2% and the valuations in stocks were much, much lower, much more reasonable, meaning that the future outlook for stocks was probably more like an 8 to 10% return. So in the world of 2% bonds and given cheaper valuations, you're looking at an 8 or 10% stock market, 2017, 2018, 2019. You could say the word TINA. There is no alternative. Get out of bonds, get into stocks. Well, 2024 is not that. 2024 is very high valuations in stocks, driven especially by the Mag 7 stocks, much lower expected returns in the future. Dr. Jeremy Siegel at Penn Wharton School and Bob Schiller at Yale University have done some valuations and said, look, you could be looking at the next decade or so of like 6%, maybe 7% returns in the stock market. That's on average over the next decade. In a 3% inflation world, that is a real return that will give you, wealth, that will build wealth. It will be a little bit volatile. I know the reason I say that is because people go, what do you mean 6 or 7%? We just had 29 this year. We had 25 last year. Isn't it supposed to go up 20% every single year, until the end of time? No, it's because the valuations were much lower. But if you're looking at a 6 or 7% return in the future, and then you gaze over and say, well, the bond market's giving me about 5 with a lot less volatility and a lot more stable return with a big fat coupon, maybe that is just flat out a competitive investment to stocks for the first time in many years. So as yields go up, not only do you look at those as saying, that makes borrowing more expensive and could slow the economy, the traditional answer. But the other answer is some people might look over there and go, isn't that giving me like 70 or 80% of what the stock market is going to offer me, 5% as opposed to 6 or 7, with a lot less risk associated with it because it's a stable cash flow income? I'll take that. Thank you very much. And so it will provide real competition to things like the stock market, especially if yields get up to 5%.
Well, let's talk about the drama in Washington right now over the continuing budget resolution. And one of the things that we're seeing right now is deficits are averaging close to 2 trillion. We're over 36 trillion in debt. The expectations of Trump coming in, he's going to bring inflation down. He's going to bring the cost of energy down. But with budget deficits this large, I think, Jim, we're paying what? Over $1 trillion in interest on the national debt, which is growing. It's larger than a defense budget. He's not in the same situation he was in 2016. What happens if a lot of these expectations don't come to fruition?
Well, then we're going to have more inflation. And he's also going to have the push-pull of being careful about what those expectations are. So Scott Bessent, his incoming Treasury Secretary, has got his 3-3-3 plan. Maintain 3% growth on the economy. We're already there. Doing that, get the budget deficit down to 3% of GDP. It's 6.5% now. So he's talking about having the budget. That's going to be a tall order. And then the last one is, drill an extra 3 million barrels a day. Now, engineeringly, physically, we could do it. We could actually increase production by another 3 million barrels a day. But here's the problem. If you give permits and you cut regulations and we drill and we get an extra 3 million barrels a day, what happens to the price of oil? It falls. It falls a lot. It might fall down to $40 or $30 a barrel. What happens to a lot of marginal producers? They become uneconomic and they go out of business. So if you get that extra supply in, then you're going to drive some of the marginal producers out. And then that extra supply, then the total production goes back down again. In order to keep an equilibrium in the market, you'd need that extra supply coming with more demand. And the problem with demand is oil demand has been waning lately, not because of the U.S., because Germany might be in recession, Japan might be in recession, China, with 1.3 billion people, is having the lowest growth in 40 years. That's who's demanding less energy, and that's why the price of oil right now is, stuck at $65 to $70 a barrel. And if you produce 3 million more barrels out of the U.S. and you drive it to 40, it might not be as economic as you think. And then, like I said, you drive those producers out and the price goes back up to 65, and then you don't achieve that inflation reduction that you think. So really what you'd really want to see happen is we produce 3 million barrels a day more, and Europe recovers, so they demand more oil so that we have somewhere to put that oil instead of just driving the price down. Look, I'm a car owner, you're a car owner. I want to see oil prices as low as possible, but also if you drive every oil company or every marginal oil company out of business, that's not going to get the price of oil down. It's going to go right back up.
Yeah, that was something that I'd like to bring up because we're close to $70 oil. Why would an oil company want to spend a bunch of money, drill and increase production to drive the price lower? Because we saw what happened to a lot of the early shale players. They produced a lot of oil, but they didn't make any money for shareholders. So companies have been very circumspect on their investing. They've been returning, buying back stock, increasing dividends, rather than, let's say, increase production or exploration.
Yeah, well, the argument would be they would do it because Trump would come along and say, I'm going to cut the red tape. I'm going to, give you cheap leases on federal lands or whatever so that I could make your production cost $30 a barrel. And he might be able to do that. But the problem with that is that's for the marginal barrel. We already produce 12 million barrels of oil a day in the U.S., and that has much higher production costs. And those production costs are fixed because those are existing fields that are producing. And if the government comes in and says, well, we'll get rid of all these regulations, well, you're not going to really, you might lower the production costs marginally around the edges, but not a lot. So if they wind up saying, here's a bunch of leases and less regulation, you could produce on these fields at $30 a barrel, and they drive the price of oil down to 40, all right, those new fields still make money, but a lot of existing fields and a lot of existing production doesn't. And then those companies will shut it down. And then that extra 3 million barrels a day that you're producing in those new fields gets counteracted by those other fields getting shut down. So that's the balance you have to look at, is that, between the price and the production costs.
Let's bring up something else. We're at a little over 36 trillion right now. The budget deficit is expected to be several trillion next year. It could be even larger depending on what happens with legislation. At what point, Jim, do we have that Liz Truss moment where the bond vigilantes show up and say, you know what, you guys are out of control, and all of a sudden rates really start to spike?
Boy, that's a good question. I think that what you said is 100% correct, in that the only person that is going to stop the budget deficit, I know the Doge committee's out there and they're going to try and cut $2 trillion of red tape out of Washington. And a quick word about that. Do I believe that Vivek Ramaswamy and Elon Musk, through the Doge committee, could identify, here's a $6 trillion budget that the government has, that they could do it with 4 or even 3.5 and deliver the same amount of government services that we have now, but save $2.5 trillion? Do I believe they can do that? Yes, I do. Do I believe that the bureaucracy is going to agree to this? That the Defense Department's going to say, just like Twitter, Elon, we could get rid of 60% of the people in the Pentagon and still keep the country every bit as safe. Could they do it? Probably. Will they do it? Absolutely not. They will fight it tooth and nail like it's the end of the world. And so the bureaucracy, Leviathan, if you will it wind up agreeing to these cuts? I really hope they do. But the cynic in me says, they will agree to some, but not nearly as much. So the budget deficit is going to stay very large. The only thing that's going to stop it, therefore, is going to be the bond market saying, no, we're not going to buy your bonds anymore. Not at these interest rates. I need to be compensated more with a higher level of interest rate. So let's drive those interest rates even higher. And once they do that, I think that is that Liz Truss moment. I don't know where that is, but unfortunately, if you're wondering how do we resolve this budget situation, I think that's the only way we resolve it. I just don't see the Democrats and the Republicans getting together and saying, look, this is unsustainable. We need to fix it before it becomes a crisis. They will do that only when the bond market drives them to their knees and forces them to do it. And they'll scream and kick at every moment, but they'll have no choice to do it. And so that's the unfortunate thing. So what I'm saying is, with the Liz Truss moment, is we're probably destined for a bond market crisis somewhere in here. I don't know when, whether it is in the first half of 25 or it's in 15 years or it's somewhere in between. That's the real open question. But unfortunately, I don't see another way around this budget issue other than at some point the bond market runs out of patience and puts its foot down and drives up yields and then forces a change.
Yeah, because if you take a look at the latest budget, or at least the initial compromise, Congress was getting a raise. They were getting better medical benefits. You've got, 90% of government workers in Washington are working from home. I think they got a 5-year contract that extends that. So it's like business as usual, a 1,500-page document that nobody's read that's full of pork.
Yeah, and the Commanders are going to get a new stadium supposedly out of it as well, too. So there's all kind of stuff on that. Now that budget got voted down, and then they slimmed it down to a 16-page budget, and that got voted down. And we're recording on the 20th of December, and if they don't pass this deal by midnight, the government shuts down at midnight. So we are recording literally 12 hours away from the shutdown. Now, quick word about this shutdown. This does not involve a default on the debt. So that was always, that was always, sometimes these government shutdowns coincide with the debt ceiling, and that if we don't pass it, we'll default on the debt. That does not happen now. So there's not that immediate concern of a financial crisis. If there's going to be a debt default because of the budget of the debt ceiling, it's still many months away. I know the debt ceiling expires January 1st, but the Treasury has what's called extraordinary means that they could do to keep funding the government even after the debt ceiling's hit for several months after January 1st. So that's not an immediate concern. The government will continue to fund essential services. Social Security checks will go out. The military will still get paid. The FBI will still be chasing bad guys. But things like national parks and stuff like that might close. And we'll have to see. Now, Trump literally, right before we started talking, tweeted out, if we're going to have a government shutdown, let's have it now while Biden is president. So he's kind of throwing down the rule on that. Now, what does that mean for financial markets? If anything, that's probably bond bullish, because it means it's like a forced drastic budget cut is what it is. You're going to shut down everything but essential services. From a political standpoint, it'll be a disaster. I'm old enough to remember in 1995 the Newt Gingrich government shutdown, and then they showed a picture of a bunch of 12-year-old Boy Scouts who rode a rickety old hot yellow bus to Washington to walk to the top of the Washington Monument to find it was padlocked. And they showed a bunch of 12-year-old boys crying that they sold chocolate bars and they got to Washington on this bus and they couldn't go to the top because of the government shutdown. And congressmen couldn't move fast enough to end that budget deficit and get the Washington Monument open so that those kids could climb to the top of it. That's the kind of bad things you will see from a political optics standpoint with the government shutdown. But is the government shutdown going to have an impact on the financial markets? No, because there's going to be no debt default. If anything, you could argue, like I said, it's a forced way to cut the budget. But ultimately, at the end of the day, it won't be, because they'll send a bunch of government workers home. And when they finally get a deal, they'll pay them the back pay. And it'll be a unplanned vacation for them right around Christmas, which is the perfect time to do it. It'll be a forced budget constraint, but probably not as big as we think.
Yeah, it's more of a media event that over-dramatizes it.
Oh, yeah, they're going to be looking for those 12-year-old Boy Scouts in Washington next week, saying that we wanted to go to the Lincoln Memorial or something like that, and they couldn't get there because there's a big fence around it and something like that.
Well, I guess as we close, Jim, the good thing heading into the Christmas season is yields are back up, so at least savers have a place to go.
Yeah, as my friend Jim Grant likes to say, who writes the newsletter Grant's Interest Rate Observer, it's nice to have an interest rate to observe again. And for investors, especially conservative investors, we're getting back to a period where, like I said, there is an alternative. This isn't zero money market fund world and 2% bond world. And the only way you've got to make money is you've got to put it in the stocks and hope they don't go down a third or a half, like they did in 2020 briefly, and like they look like they were doing in 2022. You can put it into fixed income investments, and that they can churn you a competitive investment. And a competitive investment, I would argue, is, look, like I said, I think we're in a 3 to 3-ish% inflation world. The Fed thinks it's 2%, but the bond market's giving me 5%. So I'm making real gains above the inflation rate in my investments with that kind of environment. And I don't need to risk being one of those people held hostage by Jensen Huang, hoping that even though I buy conservative stocks or I buy a value fund, that hoping that he makes the right steps, because NVIDIA could impact every single one of these stocks. So yeah, it's a good time to be an investor because there are those choices. And the last thing I'll mention to people is, remember that a bear market, I've always viewed a bear market as time, not price. In other words, the market sells off and people say, yeah, but it always comes back. Sure, but it took 13 or 14 years in 2000 for it to come back. So it took months in 2020. That was the fastest ever for it to come back. It took 2 years after 2022 to come back. If you're 68 years old and you're wondering about your investments, and you were told, yeah, well, maybe the stock market does correct in 25 or 26 by a third, your net worth goes down by a third. But don't worry, it'll recover. But what if it's 10 years? I don't have all that time. If I'm 35, yeah, I'd love it for it to go down 30 or 40% and then waffle down there for a couple of years so I could dollar cost average at lower prices for the next 20-year run, probably driven by the reality of AI and not the promise of AI like we're doing right now. But the reality of the world is the 68-year-olds have all the money, not the 35-year-olds. And so the bond market, giving that yield, is offering them a very good alternative to just buying conservative stocks.
Not a bad way to end the year looking into 2025. Well, listen, Jim, as we close, tell our listeners about your website, and also you manage a bond fund or an ETF that you're consulting on.
Yes. My original day job is that I do produce research for institutional investors at BiancoResearch.com. It is a high-end institutional product. If you're an institution, love to talk to you about it. If you're a retail investor, I am very active on social media at Bianco Research on YouTube, at Bianco Research on Twitter, and under my name, Jim Bianco, on LinkedIn. 1 year ago today, so it's my 1 year anniversary, I'm talking to you on this, we started our bond fund. Its ticker is WTBN. That's Wisdom Tree is our partner. So WT Wisdom Tree, Bianco, Nancy. It is a fixed income total return bond fund. We've had a very good year to start off our very first year, at least according to our Morningstar rankings. We're very happy with what we've seen. We're in the top quartile of our universe. And if you are looking for a fixed income investment, I'll just say this real quick, is a plug to my fund, but even to the larger issue of bond investing. It's well known that most active managers in equities cannot beat the index. So that's why we have this burgeoning business of indexation by the S&P 500 ETF and everything, because no active manager can beat it, or very, very few can. But in bond funds, it's much different. Active managers can beat the indexes about 50% of the time. So you want to go passively investing in certain type of indexes and index sectors in equities, but in fixed income, a better approach is an active approach, whether it's WTBN or there's many others. And actually, one of the larger sectors of bond ETFs that has been rolled out this year by the PIMCOs and the Vanguards and the BlackRocks of the world has been actively managed bond ETFs for this exact reason. How should I invest in bonds? Should I buy mortgages? Should I buy corporate? Should I buy international? Professional managers can do better than just saying, I'll just buy the index. And most of them actually do.
Well, super. Well, listen, Jim, I want to thank you for joining us on the program. Merry Christmas and Happy New Year to you. I look forward to talking to you once again next year.
Enjoyed it, and Merry Christmas and Happy New Year to you too.
Financial Sense Wealth Management has been ranked as one of the top registered investment advisors in the U.S. by the Financial Times. To speak with our financial planning and wealth management team, give us a call at 888-486-3939. Or you can also visit us on our website, financialsensewealth.com. If you aren't already a subscriber to our weekday podcast and would like to listen to more of our content where we regularly interview book authors, industry experts, and market strategists from around the globe, go to financialsense.com and hit the subscribe button. On behalf of Financial Sense Newshour and the Financial Sense Wealth Management team, we hope you have a pleasant weekend.
The Financial Sense Newshour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the Newshour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of the Financial Sense staff and do not take into account listener suitability, objectives, or risk tolerance. Financial Sense Newshour and its parent company shall not be liable for any financial losses that result from investing in any companies mentioned in Financial Sense or arising out of the use of any material on the Newshour. Be advised that you invest at your own risk.